Right, performance appraisal in F5 often worries people because they have to write words and describe things, which some people don't like doing. They prefer to have their calculator and just rely on a few numbers. But you have to do both. You have to produce some numbers and also explain what's going on. In fact, most of the questions are relatively straightforward to get good marks on, because there's many things you could say. You don't have to come up with everything the examiner can think of, but you have got to get a few sensible points down. And there are two main thrusts to the area that we need to be on top of. One is to realise that the performance cannot be entirely explained or looked at by looking at only financial numbers. So many of the questions have financial information to start with in part A. They want you to comment purely on financial information. Then in part B or C, they introduce the other information, and that widens your assessment, allows you to maybe retract some of the things you said before and say why you're retracting them and so on. So it's a much wider picture than just the financial numbers. Financial numbers are an important part of that, but are not the only thing that we look at. The second issue is to bear in mind that when we're talking about them, we need to try to connect things together. So we need to take measures we've found in both financial and non-financial areas and connect them together, or maybe just in financial areas. So for example, if we have interest cover has gone down, that might be connected with the fact that we've raised a lot more debt has been issued, and that's affected the gearing, but that money has then come in, which has maybe helped on our liquidity, which has then been invested in some areas and so on. So we need to try to connect things together. So let's have a look through. First of all, we've got down the idea of stakeholders. A number of stakeholders are interested in the organisation, whether it be shareholders, lenders, potential investors, potential lenders, suppliers, customers, employees, government, all sorts of people might be interested. So to start with, let's look at the financial side. And for financial side, we have ratios, which might be looked at. And they fall broadly into these four categories of profitability, liquidity, financing and investor ratios. But that's not to say investors are only interested in investor ratios. Shareholders might well be interested in profitability, for example, as well as some of the other areas. So what have we got? Profitability ratios. We've got everything looks at the profits that are being made, return being made. So we've got operating profit margin, which is the profit before interest and tax over the sales revenue. A net profit margin, the net profit after tax normally over sales revenue. So a 10% profit margin versus a 2% profit margin and so on. We've got the expense ratio, which is the other side, the costs or expenses over the sales revenue. And then we've got various others. We've got the returns being made. Return on capital employed is the return that all providers of long-term finance are getting. So that's long-term debt finance and the equity together. So to be consistent, we need to take profit before we pay our interest, because interest is payable to long-term debt people. So we can't have profit after interest over debt and equity, because the debt people are then had their return. So it's profit before we start paying out. What's available to provide us long-term finance is the money or the profits being made before we pay out any interest, so before interest and tax. Whereas return on equity is only looking at the equity, and we'll take book value of the equity from the balance sheet, shareholders' funds, or equity in the balance sheet, and looking at what's available for them, which is profit after tax, all the way down after interest and after tax. The asset turnover ratio, sales revenue over the capital employed, so long-term debt and equity, just like capital employed up here. And operational gearing is ratio of fixed cost to variable costs. Liquidity ratios, looking at the current assets, current liabilities. Liquidity very much about the amount of cash you've got in the short term. Solvency, not a term we use. ROI and RI, return on investment, residual income. Return on investment simply looks at the percentage return we have made this